Okay. Good afternoon, and thank you for joining the West Point Thoroughbreds and Green Group 2023 tax webinar. Today with me, with me today is Len Green. He is the managing partner for the Green Group. Len, I speak for our partners and for West Point when I say thank you very much for doing this. We've done this a few years now, and the feedback from our partners has been tremendous. I think they enjoy the conversation that we have, in addition to learning a lot about, some of the tax implications and benefits to participating in, the racing partnerships as it relates to, racing or even the breeding side of it, and maybe a little bit of the stallion share activity. So sincerely thank you for doing this and taking the time out of your busy day. I know we just got past the 10/16 deadline, so it's like your first day of freedom back. So before I really introduce Len and really do the deep dive into the tax discussion, just a few general housekeeping rules and information. This call is being recorded, so don't worry about trying to take notes and think you're going to miss something. Sit back and relax to the extent that you can. I know that we're talking about taxes, and that really freaks people out, but it really shouldn't and doesn't need to. So we'll have the replay ready in, within the next 24 hours. We'll share it on Chatter and include it in the weekly bulletin, as well as posting it on the website. And as we move through this discussion, I really encourage partners to use the Q&A feature or the chat feature on the bottom of the Zoom call, to submit some questions, and, we can address them in that current topic, or we can also circle back at the end of the call and address any other remaining questions or things that we didn't get to. I know a handful of partners submitted questions ahead of time, and we'll work to make sure that we get those addressed as well. So Len Green, he and his family, on a personal note outside of the Green Group, they have been longtime owners and breeders and involved in the racing game. They've campaigned a handful of notable champions such as Jaywalk and Wonder Wheel, just to name a few. The Green Group really has a significant presence in the accounting world, and especially within the horse racing industry. They have over 400 clients within the industry, between the racing, breeding side, like you name it. They're very well known, very well connected, and our partners especially have really enjoyed working with the Green Group in more of like a consulting capacity, which I'll touch on in a minute. It's been what, Len, like 6 or 7 years that we've been working together?
Yeah, in fact, when we first started, we had 400 clients. Now we have 800 clients in the horse business.
I will have to update that.
No, some of these webinars have really taken off because, again, there aren't any other accountants who actually own 200 horses or have won 2,542 races. So again, we know every aspect of it, which makes it a little different.
Well, and it's definitely beneficial. Like, you definitely have the expertise, knowledge for our variety of partners and whatever their personal situation is, like, in addition to just their West Point ownership too. So one of the perks of being part of the West Point team and a West Point partner is our relationship and connection with the Green Group. And as a West Point partner, we're going to provide Len's contact information, and his firm will spend time with our partners. If you want to explore creating an LLC to have your ownership in, or taking on your tax work, things like that. So that's definitely an option. I know a handful of partners that have utilized the Green Group as a resource, and the feedback has been tremendous. Nothing but positive words. And those partners are really appreciative from Len and his team.
Leave that up here. Leave it here.
So Len, let's get started. We'll talk about, what we came to discuss, the tax stuff. So just in terms of the 2023, it's already middle of October. We're going to be working on all of these returns really in the near future. What are some of the trends and, updates that you see as it relates to this specific tax year?
Okay, thank you, Lindsay, and I really appreciate it. We have over 30 West Point clients now alone, besides all the partnerships, and we do that by saying to you, if you have a question, it's complimentary. Just go ahead and call us, and we'll give you the answer. So that part of it, don't mess up. Okay. Number two, okay, you're very, very fortunate in your partnership. And Lindsay, just step back for a second. You're one of the few partnerships that actually gets the K1s out, okay, before March 15th, which gives all the investors an opportunity to then give it to their accountants and actually file on time. I can't believe that there's no other one that we're doing, and we do a lot of them that have the information that allows us to be able to do that, which again, my compliments to you. All right. As far as the tax law is concerned, people say, well, gee, Len, instead of 100% write-off on horses, isn't it only 80% now? And you would think that's negative, but what happens is 80% of the horses that you buy, you write off in 1 year, the 20% becomes a net operating loss carry forward to the next year, which means it's 100% of it then becomes deductible in that year. So even though it sounds like, gee, only 80% this year and you have to carry over 20%, that 20% gets added on to whatever you need to do next year. So you almost double up. So it's really a plus instead of a minus kind of thing.
So what you're talking about is, a lot of times people refer to bonus depreciation,
Yes.
and that's definitely one of the perks of horse racing, ownership, is you're able to utilize this bonus depreciation to recognize a significant loss to offset any other, income, things like that. So in 2022 and prior years, it was 100% bonus depreciation, and starting with 2023, it is 80%. So what do you think the trend will be in like 2024? And
Lindsay, would really depend on who gets into office, because there are certain parties that want to give full benefit again and go back to what we had before, and there are certain ones that are saying, hey, let's try to raise money by having less benefits. But as I said, with the 80%, the 20% becomes a net operating loss carry forward to next year. So you're going to be able to get that next year no matter what they do.
Got it. Okay.
The other thing is being active. Okay, it used to be 500 hours. And if you weren't 500 hours, you weren't active. But now when you join partnerships, you can take advantage of the partnership hours on top of yours. So again, it's very easy for a partner to become, quote, active. And what active means, Lindsay, as you know, is if there is a loss, you can take that loss against all your other income. Not if you're passive, you can only take it against passive income. So again, another big plus. And the other things are, looking at the revenue examinations now, a couple of very favorable revenue examinations have come out. Okay, they actually came out as negative, like against the taxpayer, but that's because he didn't do certain things. If he did certain things, it would have been positive. So I look at it as it's positive if you do these things, and a positive is you have a separate bank account for your horse operations. I even go so far as to say, form your own LLC and have that LLC become a partner in West Point, because then through your own LLC and your own bank account, you can take tax deductions, for going to the races and for the home office and for travel and for meals. So again, I think that's very, very important kind of thing. Another revenue examination came out that said, hey, in addition to the horse racing, if you're entering these horse partnerships to network and be of benefit to some other business that you have, that's another positive kinds of things. So again, I think you put those things together, okay? And the fact that I know this past summer we went up to Saratoga and there was Terry Finley holding court, okay, in his little area, which I think now is called the West Point other syndicate area kind of thing. And the number of people talking and discussing things, I think those are real positive things that come out of it. Plus, the real big thing is the IRS says, is there a chance to really make any money in this? And some of the claiming partnerships who say, yeah, we do all these things, blah, 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 but there's no chance to really hit the big home run. Okay, the way you're doing it with the kind of horses that you're buying, parts of it, et cetera, kind of thing, you really have a chance to hit the home run. And if the horse is a filly and does well, you have a chance to sell it later on, okay, as a broodmare. So those are the ways you get into positions where if then lightning hits, okay, you can really score well.
Right. Diversification, I think, is key to your point between the colts and the fillies for the residual value.
Right. And the shares, maybe also if you ever go into that area of it. Yeah.
Right. Yearlings versus 2-year-olds.
Greenlings. Yeah.
Some of the breeding ventures that we've done in the past and will most likely do also in the future. But
and then a number of them, Lindsay, are actually going overseas and buying a horse and bringing it back here because there's so many more turf races, okay, in the United States now.
Yep, definitely. So just jumping back to the whole LLC concept, that's definitely become a more prominent, question from our existing partners as well as new partners. Our existing partners, a handful of them have, maybe made their investment in a few horses in their personal name. And then, we get to year 3 or 4 and they inquire about, well, can I put this in an LLC? Which you definitely can. And, how can the Green Group help with the administrative side of creating and establishing an LLC?
It costs somewhere between $200 and $300 to form an LLC. And it's very, very worthwhile. And you also get an ID number, which means you then can set up your own checking account for it. As far as filing the returns are concerned, even if you were in personal name the year before, if you're now turning it into an LLC, when we do the tax return, okay, we easily can shift it, okay, and shift your capital accounts and everything else, okay, to the LLC.
Okay, and then in terms of timing, with the middle of October, is it too late for people who maybe bought earlier in the year to create an LLC?
No, what you do is you create the LLC now, and we make a journal entry to take what you had before as a personal and put it into the LLC.
Okay. That sounds so easy.
Well, it's like again, when you handle as many clients as we do, it's easy.
Right. And then so for, the West Point side of it, a partner would just notify me of that change, provide me with their new LLC information and some additional documentation. And it's very easy and straightforward on my end and also the tax side too, which is the point that I'm trying to make, is that it's simple.
Okay. And then Lindsay, one more thing, if I could. Okay, in looking at a number of tax returns, there's a lot of people who are in different kinds of partnerships. In West Point, we check with you to make sure and then we check with Equibase, make sure the horse is still running. Okay, you already do that for us. And many of the other partnerships, they don't. So they're sitting there with horses that are not racing anymore, and yet they're not taking full tax advantage of them because they no longer are racing. So again, just to take a look, if you have partners who are in different partnerships, just either you look or send us the partnership thing, and we'll tell you whether there's some tax deductions that are in suspense on the return, but you can really use them because the horse is not running anymore.
Okay. In terms of the LLC, you know, we have a handful of partners who, you know, there's the LLC itself, and when you establish an LLC, you have to indicate the type of LLC in terms of, you know, for tax purposes. So I would say the majority of people are a partnership or a sole member, right? Partnership, you have to have 2 or more people. Sole member is 1 individual. Is the treatment different? Are the
Yes.
benefits different? Like, do you encourage someone to go one route or over another?
Very, very good question. That's if I was in class at Babson, okay, I would give you 2 stars for that. You got to understand that Terry Finley came up to Babson. Okay, he may be leaving your organization and start teaching because he did a great job up there. Because the questions the students were asking were all different kinds of craziness. But again, directly to your question, the reason why it's such a good question is if you're a 1-person partnership, 1-person LLC, for tax purposes, you're treated as having to file a Schedule C or a Schedule F, which means you have to list everything under it. The IRS is under real scrutiny to observe it. If it's a 2-person LLC, then it files its own tax return. And very few of those, okay, are examined as closely as a personal return. So really, a 2-person LLC or more, okay, is almost essential.
Got it.
Now, it can be 99% 1 if you want to, okay, but it's got to be at least 2 people.
Right. So, some people are curious, like, if they utilize the Green Group to create their LLC, and then, you know, would you also prepare the partnership return and handle filing that return as well?
If you twist my arm, Lindsay,
Okay.
the answer is yes, of course.
I get, you know, I think handling a process from start to finish being the filing piece, that really puts, you know, gives people peace of mind to know that the whole situation is handled. Just because, like, you know, the tax stuff is intimidating to a lot of people.
Right.
The rules are constantly changing. You might feel like you're not always in the know. So I think it's
Thank you.
good to
And
have.
also, Lindsay, the other real advantage I think is if somebody says to me, I want you to prepare my return, I'm in the horse business, I will then ask them a series of questions that because most people have these expenses, how come you don't have it? And very people say to me, yes, I have a home office with a screen. I watch the races, but I didn't know you could take a tax deduction for it. My accountant says you can't. Well, in the old days, you couldn't, but since COVID, you can. Okay, my accountant says if I go to the races, I'm really going for my pleasure. No, you're going to watch your horses, or you're going to talk to Clement, or you're talking to Terry. You know, so there's a real purpose to it, and the answer is yes, it is deductible.
Right. So actually, let's just kind of run through some of the additional things that probably, you know, expense-wise are incurred by our partners that would contribute to their LLC deductions. So airfare, hotel, tickets to the Breeders' Cup, eating, you know, restaurants, feeding yourself during these trips,
Right.
paying
And
to
again,
attend
just
webinars.
to add to that, Lindsay, just so if the business purpose is to go to the races, okay, well, then all expenses connected with it suddenly would become deductible. Okay, if you were just incidentally, doing it, but you're going to spend a week out in California and you're going to spend one day, okay, at the horses, you would say, well, then 1/7 is usually. But if the main purpose for going out there is okay for it, then a lot more of the expenses are deductible.
Okay.
And again, you're not going just for the race. You're going for the race. You're going the day before, day after. You're going to meet with other partners. Can you see the whole business thing changes?
Right. So what about the whole 500-hour rule? Do you think that that is something that people really need to keep track of, or is it kind of
there's two rules. There's a 500 and there's a 100. Okay, the 500 it is usually if you're doing it alone. Okay, then it's your hours or your hours and your spouse's hours. However, if you're joining in a partnership, okay, it shifts to about a 100-hour limit. Okay, and that's so easy. I mean, I don't know of anybody that who's a partner who isn't following his horses or following the industry that can't meet the 100-hour test.
right? Yeah, no, that's a very good point. Anything else that really comes to your mind that you are asked repeatedly as it relates to LLCs, whether it's establishing them, filing the annual returns?
The home office is the thing that many people miss, okay, because the old rules used to be if it's for your convenience that you have a home office, you can't take a deduction for it. But since COVID, okay, if you actually set up a room, okay, we have our room with the television set in it, with the computer in it, okay, with the list of the horses, okay, the cable that we have, okay, that we actually utilize it for, okay, well then that time is added to your 100 hours also, and you can take a percentage of the deduction. So it really is very, very worthwhile, I think.
Okay, so a question from a partner is, can a married couple create a two-person LLC?
That's probably the best way to do it. Okay, we had one in which my wife had 51% and I had 49%, which made a lot of sense from a tax point of view, except when we started making decisions, she would always say, okay, let's vote.
So, that's great.
Okay, the only one you can't have is, we saw one this past tax season where I looked at the partnership. He said two-person partnership, and there was one for him and one for Spot. And I said, wait a second, Spot does not sound like it's my dog, it's my favorite. No, it's gonna be two human beings.
So what about if you have two partners, and can you have a difference between who wants to be active and passive? Or do you
Yes,
have
you
to be the
can't.
same?
No, that's great. It's another great question. You can have a different percentage, believe it or not, of profit and loss, and a different percentage of capital. So you can actually have someone inactive and someone active. Also, a lot of people, Lindsay, actually go one step further and take a corporation, okay, and they get the 1% general partner, and they become the 99%, okay, limited partner, but the limited partner gets 99% of the profit and loss. So again, it's just different ways of doing it. And again, if somebody wants to ask me their situation, I was certainly giving my best advice.
Okay.
Okay, we actually put our children into our partnership, which is why it's DJ, Debbie, and John Green. Okay, which is, again, just to get them more involved with us, to go to places with us. So again, it served a couple of different purposes, not only the social, not only the tax, but also getting them involved in some kind of family activity.
Okay, great. So speaking of family, what about, like, I have an LLC, and like my husband and I, we split it 50-50, and we're going to bring our children to the Breeders' Cup. Are we allowed to deduct our expenses and our children's expenses too?
Yeah.
Like, is there any
Yeah,
limitation on that?
again, Lindsay, I was kind of alluding to that when I said, and my kids are also involved 1% each, okay, in the partnership.
Do you have to be an
You don't
owner?
have to be.
Okay.
You certainly do not have to be. Okay, if the purpose is you're going, okay, what I try to avoid is possibly the IRS saying, okay, then the part for the kids, okay, is personal, and that the rest of it's all business. So I avoid that by actually giving them 1% limited partnership interest.
Okay, that makes sense. So a partner is asking about, you know, the hobby versus business rules. You know, I think that this topic has really come to light the last few years, especially with, you know, trying to be, you know, profitable for a business versus a hobby. What is your take on that as it relates to ownership through racing partnerships?
Yeah, again, a very good question. We have never lost a revenue examination on hobby, but it's only because we sit down beforehand and look at the operation and say, okay, profitability, believe it or not, is only one of 9 tests. You have to have at least 5 of the 9 be to not be considered a hobby. But profit and loss is only one of those 9. The other is, are you running it as a business? Okay. Do you have a good set of advisors? Which again, partnership certainly does. Are you running as a business? Certainly you do, because you guys go out and look at every horse in the sale. You bring in the top trainers to train them. Okay. You have a game plan. Okay. Those are all plus, plus, plus. Okay. The reason why I said have a separate bank account and not commingle it is, again, checkbox. Okay. You're doing it right. You're not commingling business and pleasure. Do you have a chance to be profitable? The answer is yes. When you buy a $5,000 claimer or a $10,000 claimer, or some of the other partnerships that are in this, okay, where you have a micro share of something, there's no chance in the world of being profitable. Okay? But here, there's a real chance that you can hit a home run, that the horse can win a big race, that it can be syndicated, or that a filly, okay, can be sold at a profit. So you really have a profit motive here with West Point, which is really great. So I would say that any partner in West Point, especially if you're not only in one but in a couple of them, and actually go up to Saratoga and actually go to the races, and you got it. I'll defend you, and I'm sure I will win every single time.
So that actually was a good lead in to my next question of, if a partner, you know, works with the Green Group to have their LLC set up, Green Group, you know, prepares their return, files their return. If there is any sort of hiccup with the IRS, like, the Green Group helps the partner. They're not left, you know, high and dry to defend themselves.
We help them and we win.
I like that. I like that. Okay. So another question from a partner. This partner has currently an LLC, and if they breed a horse in 2024, what would the treatment be for the stud fee and the broodmare costs for tax purposes?
Okay, so I'm assuming that when you question that they own the broodmare in 23.
Yeah, so they currently own the broodmare.
Good.
They're paying.
Fine. All right. So if they decide that they're going to pay the stud fee, okay, live foal stud fee, okay, they can take the tax deduction in 23 if they pay the stud fee in 23. If they wait, okay, until 24, they actually can take it then. If you also buy a broodmare, and this is an interesting one, Lindsay, that most people don't realize. If you buy a broodmare in 23 and it's in foal, you actually can take a tax deduction for that in utero foal at its stud fee. So it's another little added advantage.
So would you say you bought this mare for $400,000 in full? And like, would you deduct, or I guess, would you subtract that stud fee from the 400,000
Yeah,
to
but
establish that?
that stud fee that you pay, yeah, that you separate is 100% deductible, and then 80% of the remaining broodmare is deductible under Section 179. So you can see you're getting an extra deduction,
Okay, so,
and then all the upkeep of the mare is deductible.
okay, so, kind of going off this example, you buy a mare in full, and you buy a mare in full in 2023. She foals in 2024. At the end of 24, you sell the foal.
Right.
So if you had not done what we just described in terms of allocating a portion to that stud fee, would the income from the sale of that foal be considered ordinary income or a capital gain, or?
So the strange negative rule about horses is, now the normal rule is if you hold an asset for a year and a day, it becomes a long-term capital gain. In the horse business, it has to be held for 2 years to get a long-term capital gain. So anything short of 2 years holding it is ordinary income or short-term capital gain. Okay. But again, what you're looking for is, can I get an immediate tax deduction in a particular year and have the use of the money? If next year I sell it and have a profit, well, then maybe I'm in a partnership that throws off a loss, and then the loss is fully deductible. You can take losses up to $500,000 per, and then again, that's another interesting one, and maybe I'm going too fast. It used to be able to take all the losses that you had against, and assuming you were active, against all your other income. Then they put a rule in that limited the amount of losses you can take. And let's say 500,000, just to use a number. Okay. But again, if you don't utilize all that 500,000, it becomes a net operating loss carry forward, and it becomes deductible in the following year. So again, it's just timing. The whole thing is to cut down on as much of the taxable income as you can in any particular year, have the use of those funds that you would have given the government, okay, and then worry about next year.
Got it. Okay. Jumping back to the LLC setup, do the majority of partners that you do this for, do they have any sort of a business plan? Like, is that something that partners should have? What are your thoughts on the whole business plan in general?
It's interesting because, okay, one of the IRS 9 points is, do you have a strategy? And a lot of people consider strategy being, do you have a business plan where you lay it out and do a projection for 1 year and 5 years and 20 years? Lindsay, I know I'm being crude on this, but if you're going to do a business plan like that, do it on toilet paper, because as soon as you start running, okay, at least it'll be useful for something, brother. But you should have a strategy. And that isn't strategy what West Point is all about. I mean, you're not just buying horses for the sake of buying horses. And some of the partnerships, buy claim horses, or buy horses for 20,000 or 30,000. Yeah, there's an occasional one that'll jump up, but your chances of making any real money with those horses versus the cost of the upkeep, plus the fact you're not getting a Chris Clement, or you're not getting the top jockeys. Your chances of really hitting lightning is very, very small, kind of thing. The best strategy is you go into a partnership like this. And again, I'm not a spokesman for you, the partnership. I'm not getting commissions or anything like that. It's just, I believe in it. Okay, I believe in the way that a guy like Terry Finley is running the thing, because you really have a shot at making the home run. And that's the best strategy in the world. And you can point to different horses that West Point has had over the years, okay, and how many of them have gone to the Breeders' Cup, etc. Because that is the best strategy in the world to overcome any IRS thought that you're not in this thing to make money.
Got it. Okay, thank you. So taking a step back and talking about the West Point entity itself that, you know, partners buy an interest in, where each horse is its own taxable entity. It has its own tax ID, it has its own tax return that I get you the K1 by February, the end of February every year, so that you can file on time. And included in that K1 package is the federal K1 and then the Kentucky K1, because we are established in the state of Kentucky. So anytime a horse runs in California or New York, that would be the triggering event where you would have to file in additional states, right? So are there, you know, sometimes partners will ask me what the rules are for any given state. I realize that each state is different, but ultimately at the end of the day, we're providing this documentation to our partners, and, you know, the Green Group is a great resource for them to have the discussion of what are the filing. I don't want to necessarily say obligation, but what are some of the things that our partners really should be mindful of as it relates to filing in various states?
Yeah, that's a great question also, because again, it would depend on where they live. Okay, because then they'll be a resident of that state. Okay, they're a non-resident. Let's say Len Green is in New Jersey. Okay, when I get my K1s from Kentucky, okay, well, I don't have to worry about it unless it's profitable. Okay, if it's a loss, I'm a non-resident in there. But so the first thing I look at when I see a partner is to say, what state are they a resident in? And then look to see the rules of how I can utilize the profit or loss from a partnership in that particular state. So yes, we can do all those things because we have, as I said, we have 800 clients all across the country. So I know almost every state's tax thing. Okay, so I can tell you how to handle it from a state point of view.
Okay, and then so that also sparked another question in my mind is, when you create an LLC, you know, if a partner wants to do that, do you have like a go-to state that you encourage people to be set up in?
Yeah, there are certain states that are favorable if there's ever any examinations or lawsuits, et cetera, kind of thing. So certainly Kentucky is one of them. Delaware is another one. Okay, but again, if it's not that kind of issue, well, then it's probably the state that they're domiciled in is probably the best state to do it in. The less expensive state, obviously, is Delaware because it's home, because well, that is the biggest state, okay, and has the best rules in favor of the taxpayer.
Okay. So for an LLC, say someone set themselves up as a partnership, circumstances change and they want to change from a partnership to a sole member, or, you know, maybe it's the reverse scenario. How do you really address that, if you can at all?
Yeah, and you almost have that in West Point all the time. When a horse is retired, okay, we close up the partnership. That's one of the real advantages. I'm sure the most partners don't realize how advantageous what you're doing, although it's causing you a lot of extra work, Lindsay. It's so much better that a separate one be set up for each horse, because then you can close up the partnership and take whatever tax advantages are there and take them in the final year. So many of the partnerships commingle and they throw them all into so that they have 4 or 5 or 6 or 8, 10 different horses from different years, and it's a nightmare.
Right. So your recommendation would really be to dissolve your current entity and start new.
Yeah, because it's very simple. You wrote down final year, okay,
Okay.
and then pick up whatever is in something else. Yeah.
Okay. So, this has become more a question more so in, I guess, the last 2 years. The K3, that additional informational page about foreign
Yep.
income expenses.
Right.
We have horses that have, gone to Woodbine, so that would be a triggering event really to include that form. Can you talk a little bit more about that form specifically? I've had a few questions about it.
Yeah, you know, I bet you if you asked 100 accountants, okay, very few of them would know, but we run, okay, the largest string up at Woodbine, okay, for the DJ stables. Okay, so I am very, very familiar with it because we have it all the time. And the other part of it that is the most confusing is the exchange rate. You see races at Woodbine 100,000, but that's 100,000 Canadian. Okay, so you got to translate that into US. Okay, so that is, but the purpose of the K3 is not to hinder you. It's to try to find out who's doing business in other countries. Okay, that is not being reported to the United States. So
Right.
again, let's say you had a horse running in Canada. Okay, so if there was Canadian tax taken out, well, then we'd be able to take that Canadian tax and get it back, okay, by filing, okay, with it. So again, it's no problem because our software is all set up for it, and it's set up really for Lenny Green originally because he ran so much in Canada, and then we started running some of the horses in Europe because there's a certain advantage to buying European horses that are over there and then leaving them over there for certain races and then bringing them back. So now we've adjusted all our software to be able to do that effortlessly.
Okay. Wow. All right. Do you have any advice? Like, we have a handful of new partners, as I mentioned, we have anywhere from 60 to 80 new partners every year. Do you have any tips and advice for them with this being their first go around of ownership with us and getting the K1s?
Again, it's more of a personal kind of thing that I can say to them. Take advantage of the fact that you can talk to first-class trainers. You can talk to Terry. You can talk to yourself, Lindsay, okay, and get answers to questions as opposed to an awful lot of the partnerships don't have that. You can't ask questions. You can't go. I mean, you obviously can't pet every horse. You can't go to every paddock, but you certainly can get involved in these things and really enjoy them to the utmost. Okay? And that's really what it's all about, I think. And then also, to me, I think it's very important to have the other aspects, which is the giving back. Okay, and you can talk to people about giving back and donating horses or giving to charities that involve horses the way Terry is involved in New York. And it just, there's so much more to this game than just betting on a horse or saying I own a piece of a horse. It's getting the whole picture of it. And as I said, we're very fortunate. We've had claimers, we've had every aspect of the business, but we've learned over the years and we've made our mistakes. But the chances of again, somebody asked me the other day, how do you get to be profitable? Well, it's really comparatively easy. If you win the Eclipse Award and you win the Breeders' Cup, okay, you will be profitable. And you at least have a chance to do that, Lindsay. So the new people coming in, they ought to take advantage of asking questions. They ought to stay on after this, okay? And if you're going to have a trainer like mine, ask him questions about horses. Why would you put horses in certain races? What do you look for? How soon can a 2-year-old, okay, race? And is it better to race on the dirt or on the turf? Those are the kind of questions that you ought to be asking so that you really get the feel for it. So when a horse wins, you know that it's not just luck. It's somewhat luck, but an awful lot of it is strategy and putting the horse in the right place and buying the right kind of horse. I mean, again, sometimes they would ask Terry how many horses he looks at a sale. Okay, and I bet he tells you in the September sale there are 3,000 horses, and he must, between him and the rest of the team, they must look at close to 3,000 horses in every book before they pick it up. That's the advantage that you have over somebody who just has a 1 or 2 person partnership, and you're increasing your chances for success.
Great, thank you. A question from a partner. Who makes the ultimate determination of whether or not you would be considered active or passive?
You'd be active if you did those 9 things that I was talking about. If you did 5 of those 9 things, you would be active. So again, it's really simple. Okay, you make the determination. Now, again, you may have to tell your accountant that you're active, okay, because you do these various things, because most accountants think, well, it's either a hobby or it's passive because you're another business. How can you be active in the horse business when you're putting in so many hours in your real business? And the answer is it doesn't make any difference how many hours you're putting in the other business. Do you have these 9 things that you're doing? And if you're doing them, you're active.
Right. And so before all of the partners jumped on, Len and I were talking about active versus passive. And one of the things that we discussed was that, when you get the K1 from me, it's really important that you open it up, you look at it, you check the name, the tax ID number, your personal information. And unless you tell me otherwise, I put you down as passive. So if you really want to be active, I need to be aware. And otherwise, when you go to pass this K1 onto your accountant and you're telling them that you're active, but the box is checked off that you're passive, I mean, that's going to be part of the issue, and maybe disagreeing with your accountant too. So, definitely be sure to review what you receive from me to make sure that we're, on the same page. And if not, you just have to tell me and it will be updated. So we have about 5 minutes left before we have to jump on the Tuesdays at 3 this week with Christophe Clement. So if you have any additional questions, please submit them through the Q&A box. I feel like we've addressed a handful of the questions. I did see one for an actual bonus depreciation calculation, which I will reach out to that partner separately and send them the math equation.
Lindsay, by any chance, is Terry on?
Terry is on. I'm not sure if he is available to talk or if he's also.
If he is, as I said, he did a great job up at Babson. But the one thing that he came through with was, why join this organization? Why join these partnerships? And he was very. I think he really said it very, very well, that it's a combination of things. You're not just buying a piece of a horse, you're buying a piece of an experience.
Definitely. I mean, so I really think that West Point goes above and beyond in the experience department. We're bringing over 200 people to Santa Anita for the Breeders' Cup in a few weeks. I know it's an event that a lot of our partners look forward to. A lot of our partners are now close friends, which is it's really great to see that. And it's always a great weekend for everyone to be together, watch the races, travel, catch up on life. So it's definitely a very good thing. One last question that I just got was, if you own in your personal name, are the expenses of the LLC, what they get in their K1 from me, is that deductible against their ordinary income or personal income?
Okay, let's go back once again, because again, I did cover that before, but let's cover it again just so that everybody, because it's a little bit complicated. The K1 would go on something called a Schedule E, okay, and it would just be a one-line item, okay. Whereas if you had your own LLC, then you could deduct those things with your own bank account, with your own LLC business account, and then those expenses plus the K1 from West Point would appear on that line. So it would then include all the expenses, which is why I say again, form your own LLC and then join a partnership so that you can deduct the travel and all those other things that you so well laid out before as a deduction, including the home office. Okay.
Do you have a website that you refer people to look at if they're looking for guidance on the 9 things that the IRS looks at?
We actually have it on our website, the Green Group.
All right. We'll share Len's contact information as well as the Green Group website, which I had shared last week with everyone on Chatter. So we'll definitely give that information onto our partners again.
And again, as strange as it sounds, okay, I'm not soliciting your tax work or accounting work. If you have a question, it's complimentary. It just, at least you can see these things on there and the 9 things, and so it just makes it easier. I love this game. Okay, to me, it's one of the great challenges in life to win at something that people say you can't win at. You can win at this game. You just have to have some strategy that makes some sense, and you have to be involved with things that are honest, and you have to be involved with opportunities to get the best horses and the best trainers and the best spots. Okay.
2 more questions, and then I think we'll call it for the day. I am in 4 partnerships. Should I form 4 LLCs for that ownership, or should you form 1 LLC?
You can form 1 LLC and then put your ID number on all those other partnerships, so that when the K1 comes in, it'll funnel into one place. And then you can also take your ordinary deductions out of that 1 LLC and then file 1 consolidated LLC.
Okay. And then I live in a state other than Kentucky. Are all of my federal losses deductible in my home state?
Yes. Assuming that the state is taxable. Okay. If you're in Texas or Florida, obviously you're not filing return, okay, in that state. But yes.
Okay. Great. Let me do one last check. Okay.
Except if you live in Canada, because Canada doesn't let.
Awesome. Well, Len, thank you so much for doing this. I know that I have learned some good information this year, and I'm sure our partners have as well. I will share your information with everybody. I'm sure you'll get a handful of people reaching out for some assistance with the LLCs and additional guidance. And yeah, Thank you.
Okay, unlike you, we also are gonna have 2 horses running out there in San
Oh,
Antonio.
great. What are the
That's
names?
Can Group is
Okay.
a 2-year-old, and Web Slinger, okay, is the 3-year-old.
Excellent. Well, good luck. And
Good luck to you guys too, okay? And all right, and
Are you going to
Lindsay, it's a pleasure doing business with you. Again, I tell Terry if he's on, give her a raise. She's one of the best.
Thank you very much, Len, and I hope
Good.
to see you in California.
Thank you. Bye.
All right, thanks. Have a great day, everyone. Thank you for joining.